talking about, everything changing, nothing changing. We're still talking about Europe. We're still concerned about the debt ceiling in the States. But ECB decision today, as expected, unchanged rates there.
Yeah, look, I mean, nothing really has changed, obviously, because it's just a new year. But we must understand, the world is still a much better place than what the outlook was 2 years ago. And it'll probably continue to improve. Now, it doesn't mean the world's a good place. It just means it's not as bad as what it used to be. And China looks a little bit better, and the US looks a bit better. Europe, if you believe Draghi saying we'll be okay by the end of the year, we'll show some growth. So the outlook is reasonable, but we understand markets aren't stupid. The share market's already taken into account last year that the outlook for this year is reasonable. So now the market's worried about what's the outlook for 2014 and 2015. And it still seems positive because the market's going up.
Just looking at some of those comments from Draghi today, Mario Draghi, head of ECB, talking about that turning point and when you're going to really start seeing the recovery, the momentum in the Eurozone return, and saying that, of course, you need to see more than just the financial stability. And that, of course, is indicating you need to see jobs growth.
And we saw that economic growth,
record low unemployment figure coming through from the EU.
But look, you've got to have a look at what they've done in Europe. Number one, a good couple of years ago, Germany decided we're in and we're here for the long run, and almost irrespective of what the cost is. So that's a positive sign. Secondly, you saw on the back of that the big intervention to get the bond yields down in Spain and Italy in particular, because those economies really do count. And they have been very successful in doing that. In fact, the success continues this year. So they've alleviated the possibility of government defaults, essentially. But now you've got to get the proverbial Joe citizen out there to feel more confident, to not to worry too much about their job, not to worry too much about the price of their houses, and to go out and spend a little bit of money and create a few more jobs. And then when that happens, the companies will come in and spend a bit of cash and put in a bit more infrastructure. But it is going to be a long, slow haul in Europe. But clearly the worst is already behind us.
And of course, in economic terms, that unemployment figure is always that lagging indicator.
It's always a lagging, but they're not going to see much joy on that front for a long time, unfortunately. They've got to get out of the psychology, which I think they have already, or they're starting to. They've got to get out of the psychology of cradle to grave socialism where the government looks after you, because governments just can't afford it anymore. So as the private sector picks up some slack, you probably find the government sector is going to let a few people go. So I think this is a long-term structural issue, and it'll be, probably in my view, at least 5 years or maybe even a decade before that unemployment number comes down to good levels. But it will improve over that time period, obviously.
Yeah. Let's just talk about the local market today and the likes of Massmart. It seems the market reacted negatively to the first half numbers. Comparable store sales up 7.3%. Now, obviously a contrast if you look at the likes of a Mass Warehouse, where you had sales there up 23%, almost 24%, and Mass Discounters, which is Game, Dion Wired, and the new Food Corp, sales there only 7.7% rise. But overall, the market didn't like the numbers.
No, look, the numbers weren't bad. They weren't as good as what they were in previous reporting sessions, but they're still in real terms, year-on-year growth, like for like, all of those good things is about 4%, which is not bad. But the problem is the share price was anticipating more. So they haven't really released a bad set of results, just that inherent in the share price, I think, was the anticipation of better results. But it's still early in the reporting season to give a comment on retail as a whole, but the numbers didn't support the share price, even though the numbers from an economic viewpoint were reasonably encouraging.
Is the market not too impatient with the likes of Massmart? Because Massmart continually says they're investing from a longer term perspective.
Massmart is a slightly different scenario. Clearly Pick n Pay is a very different scenario. So maybe they are being a little harsh on there, but I can promise you, if Woolworths, Mr. Price, Spar, ShopRite don't come out with, quite frankly, good numbers, better than these, you're also going to see some share price weakness there.
Let's just talk about the miners because Exara pointing out today that in terms of return to shareholders overall, between 2001 and 2011, it returned 39.2%, making it one of the top 10 miners in the world when it comes to return to shareholders. What do you make of the company's outlook?
I think the outlook is quite positive for them because I believe in China. So that's as simple as that. But you must remember, during that time period, you had the most wonderful bull market in commodities where the chaps, they almost became banks. They just printed money like there was no tomorrow. Unfortunately, there was a tomorrow. So the last piece 2007, 2008 onwards have not been good for all resource companies. So Exxaro is a very good resource company, but you've got to believe essentially in the fundamentals of China to go and buy resource shares. I do, and I think the resource shares are actually quite reasonably priced at current levels. As long as that view turns out to be correct, you can go and buy them.
I pointed out earlier the fact that investment houses are turning bearish in gold and favouring PGMs, favouring the more economic growth story. Gold miners right now in South Africa, where do you stand when it comes to them?
Gold miners, now I'm talking only their South African assets. We've recently seen a fall in the rand price of gold from about 15,500 an ounce to about 14,200 an ounce. I don't think anyone's profitable at 14,000 rand an ounce. So the next set of quarterly results where this gold price is applicable are going to be disastrous. I mean, they're going to really be poor. I mean, we've spoken about this so many times. There's very little gold left of good grades. And what there is very, very deep in the ground. So the cost of mining gold has far outstripped the rand price escalation. Now, the rand price escalation has been enormous. I mean, we've had seriously large increases in the rand price. Unfortunately, the costs have gone up by more. And given the state of labor in the country and given electricity and other input costs, the costing structures are not coming down. So quite frankly, I don't think there is an answer for South African gold assets. And maybe that's why Gold Fields is hiving off their SA assets. But they're not hiving it off because they're South African. They're hiving them off because their old assets with very little gold left over. So,
well, they would argue, of course, that there's still value there and all that.
There's value in anything. I mean, you can buy shares in a declining industry and make a lot of money, but understand they're not long-term holds. Like right now, the gold price, the gold shares, their prices relative to the all-share index, I think is the lowest in 3 decades. So you probably find the next month or two, we could get quite a significant rally from gold shares, but they cannot be long-term assets in your portfolio simply because there's very little gold left. So if you want gold shares, buy an offshore gold miner. Don't buy the purely domestic assets.